Alright, so for this next part of the video, we'll be discussing some sustainable ETF portfolio options that you can consider. Now, for this video, we'll have 4 ETFs prepared for you. And for this idea, we have 25% for each of those ETFs allocated. So this ensures that you have a global exposure to a wide range of industries, as well as some thematic and exclusionary ETFs, which not only try to seize the technological opportunity that exists in the coming decades, as well as excluding certain industries that could be considered unsustainable for certain people. So this is only 4 ETFs. It's not the focus of this video. If you're looking for some more inspiration in terms of sustainable ETFs to buy, I would definitely recommend you check out my other video where we've discussed sustainable ETFs. So let's jump right into it. So what do you look out for when you go about deciding on an ETF to buy? So you want to be diversified, and you want to be diversified across countries, across sectors, and across different asset classes. Now, what do I mean with that? So when you're looking at countries, you obviously want to invest into companies, for example, that exist in a wide range of different countries throughout the world. Because that way, if one of these countries has, say, some kind of financial crisis that is really like specific to that country, and you put a lot of eggs into that basket, like a lot of companies that are existed in this country, then your financial performance of that fund or that ETF or that company that you bought, that company stock that you bought, is going to drop significantly, and you're going to really be hurt by that. Whereas if you are diversified across the world, you're going to take the average growth over time that companies or sectors in this space are going to experience over time. Now then you want to be diversified across sectors, right? So for example, you could be investing into technology companies like Microsoft, Nvidia, and Apple, or you could be investing into financial companies or big banks. You could be investing into different kinds of sectors. And you want to be looking to invest into different ones so that when one sector is experiencing a shock, like for example, recently we've had a big shock of technology companies that was experienced because there was a significant breakthrough in China on a language AI model, which has caused many of these big tech stocks to drop significantly in value in a very short period of time, right? So if you invested across different sectors, you will not experience that kind of loss in a very short period of time. And then you can invest into different asset classes like real estate, stocks, bonds, or commodities, so-called commodities like physical objects that you can touch, like gold, silver, which could also be considered. Then you want to look at the fund volume. This is a really key one because the fund volume shows you how large this fund is and how likely it will therefore probably continue to exist, because smaller funds that don't have a lot of money might not exist for a very long period of time. Because they're not popular, the fund manager will close the fund. This does not necessarily mean that you will lose all your money. In the most cases, you will just get your money back. But obviously, if you want to make investment decisions and invest over a longer time horizon, it makes sense to choose a fund that's larger in its volume and therefore likely to continue to exist over a very, very long period of time. And a large fund size would probably be like everything over $1 billion or more. Fund managers continue to make a lot of money from them, so it is likely that the fund will continue to exist. You want to consider the age of the fund. The older the fund is, the better, because this shows the historical trend in terms of its growth over time. There's many funds that exist out there that actually are really terrible in their financial performance, right? So if you buy a young fund, you think, oh, this is the next best thing, I'm gonna make all this money. You invest your money into it, and it could be that it just kind of decreases in value over time, and you are actually going to lose all your money over a long time horizon, which is the worst thing ever. And therefore you want to consider a fund that's old, that has already has historical growth that you can see, and therefore you have an indication of how the fund has been performing. And obviously the past doesn't predict the future, but if you have a fund that has grown over a long time horizon, you can already tell that it invests into companies that have been doing well historically and are likely to continue that trajectory over time. Whereas if you bought into a fund that is young, that doesn't have that historical growth journey shown, then you don't really know whether it's going to continue to perform as well. So the next thing you want to pay attention to is the total expense ratio. So this is typically between something like 0.03 to 1%, which is basically the fee that the fund manager charges for the management of the fund. Now, as we said, the funds track often an index which already exists with basically a range of companies within that index, like, for example, the S&P 500, the top 500 companies that are traded in the United States. Funds that track this type of index often have a very low fee tier because they just copy this index, and therefore it doesn't take them a lot of effort to do that. Now there's other sustainability funds that exclude certain companies, therefore they have the screening methodology applied. It takes a bit of work, therefore the fund, the TER is often a bit higher. But in any case, like, these fee tiers are generally pretty low, but obviously you want the lowest fee tier possible so that you don't have to pay so much money in the long run. All right, now another thing to look out for is whether a fund is accumulating or distributing. Now, the reason why this is important is because companies within an ETF often pay out their shareholders some of their profits in form of dividends over time. Now, the way these dividends are dealt with is the distribution policy, and therefore whether it's accumulating or distributing. Basically, distributing means that these profits that are being paid out are given to you. They're being paid into your bank account as cold hard cash. Sometimes you have to still tax this income, sometimes you don't. It depends on your country or region, as well as the fund itself. Accumulating, in the other hand, means that these profits are automatically reinvested without you having to do anything about it into this ETF. Therefore, it's kind of a compounding effect, because these distributions are being paid into your ETF, and then the ETF value grows. And then as you make more, as you go into the next quarter and get profits again, these profits generate more profits as you get interest on these ones as well, right? So it's a bit of a compounding effect. The longer you hold this fund and it keeps accumulating, you get basically accumulation on the thing that you've previously accumulated, right? So it's kind of compounding and growing significantly over long time horizons, which can be a really powerful investment strategy. There's no right or wrong answer here. It just depends on your personal preference, whether you choose to want to have distributing or accumulating. For some people that are looking for some passive income on the side, this can be really effective to, make some money on the side that you can use to spend. But on the other hand, in my personal portfolio, I have accumulating because I don't want to deal with it over time. I want to hold on to my money a little bit longer. And then at some point in the future, I have some compounded wealth from this accumulation of dividends over time. So then the last thing we'll talk about is the replication of this ETF. Now, this is really important because there's either synthetic or physical. While there's different versions of this, we'll discuss these two. Basically, physical buys direct holds and actual stocks of our assets in an index, making it more transparent and generally safer. A synthetic ETF, on the other hand, does not own the real assets, but instead relies on a financial contract, such as a swap with a bank to match the index's performance. Therefore, you're kind of tracking the value, you're not actually owning the real asset. Whereas a physical replication means that you actually own the physical stock that is included in that ETF. So overall, synthetic ETFs are riskier because they depend on a third party to deliver these returns, while physical ETFs hold real investments that investors can directly own. So the first ETF that we're going to talk about today is the iShares MSCI World SRI ETF, and we're choosing the accumulating one, which means profit that is paid out to the shareholders is automatically reinvested into the ETF without you having to do anything about it. Now, this ETF comes at a low fee tier. It's a 0.2%. That means there's a small fund management fee that's being paid. It is a physical replication, which means that you get the actual stocks in the ETF and not just a synthetic kind of price exposure. The fund size is $8 billion, so that's quite a large amount, which means it's quite a safe fund that has a lot of money in it and has 398 holdings. That means there's 398 companies included in this ETF. And while it is a world ETF, it has a significant proportion of United States-based companies, about 70%, which is something to consider in terms of country diversity in your portfolio. It has an impressive annual growth of about 12.7% annualized over the fund's duration, over the fund's existence. Now, this SRI ETF excludes a wide range of different industries. So from fossil fuels to weapons to alcohol. So I would definitely think about, what do you want to exclude? Is there maybe something that you would want to include perhaps? And there's different options that you can think about. All right, next up we have the SPDR, the Stocks Europe 600 SRI ETF. This is also an accumulating ETF, so it reinvests profits paid out. It's slightly lower fee tier, 0.12%, has 327 million in terms of the fund size, 200 different holdings, and it is a very strong Europe focus. So this is kind of to give you more country diversity in terms of your portfolio, to have a more holistic global ETF. This will be a really good one with significant growth over the past 5 years and very stringent exclusion criteria to be sustainable, excluding a vast variety of different organizations or different types of industries that you might be not morally aligned towards. Then lastly, we have the iShares MSCI Emerging Markets SRI ETF. Now it's also the SRI, once again, similar to the World SRI ETF. Therefore, the exclusions are the same. And it basically looks at the emerging market space, which would be mostly Asia or countries in Africa. And don't ask me why it's called emerging markets, because in many ways these countries are more advanced than the Western world, like manufacturing capabilities of China for renewable energy infrastructure is significantly more advanced in many ways than Western countries, but they decided to call it emerging markets in this space, right? So in any case, the fee tier is 0.25%. It is an accumulating ETF, which means that profits are being reinvested. It is a very large fund size of $2.7 billion. And it has 227 company holdings with a significant kind of Asian market distribution, as you can see here. And then it has, a wide variety of exclusions that we've mentioned before with the World SRI ETF. So this is, a 25% allocation to this one to kind of have a very strong, international focus. Now we've basically got the United States covered. We've got Europe covered. We have the emerging market space, or Asia covered, and they all have displayed significant growth over the past 5 years. Lastly, we have the thematic ETF that we've been talking about, which is the Amundi MSCI Semiconductors ESG Screened ETF, which comes at a fee tier of 0.35% per annum. Quite a higher fee tier because of that selection of these semiconductor companies that might need a little bit higher fee tier. It's an accumulating ETF again. It is a $735 million fund size, 66 holdings only, which is significantly less considering what we've seen in the other funds so far. But it has one of the strongest performances over the past 5 years, as the semiconductor space has been absolutely booming. So this is a very strong industry that is also really important for climate tech in many ways, when it comes to producing sophisticated technologies that are needed to, for example, power the energy transition, which are super important. There's a lot of innovation happening in that space that's absolutely key for technological progress. It also has the ESG screened exclusion criteria, so it excludes certain industries that we can see here from its portfolio as well. The country diversity, once again, is more United States based. So, in this portfolio, if we allocate 25% to this one, we have a pretty good rounded international diversity of, kind of still to a large extent the United States, but also a significant proportion in Asia, in Europe. And this allows us to be well diversified in our passive investing portfolio. In this scenario, we also assumed that we bought these shares just when they peaked before the COVID-19 pandemic in 2020. So if we had bought these stocks a little bit later, we would have made a lot more money. But to be honest, you would have made money on anything if you had bought during that time. So we just assumed that we bought it during a normal market condition. Thanks so much for listening.